Morning, everybody. My name's Colin White, and I'm the founder of Credit Connect Media. Hello, and welcome to the third edition of our online lending technology think tank series. Our event is designed to bring together lender and creditor professionals to discuss strategies and assess technological innovations, easy for me to say, that can produce best customer outcomes as we start to deal with a high level of household costs, which are resulting from the pandemic, the troubles in Ukraine, Brexit. The list seems endless at the moment. So at this event today, we'll try and go through and talk to various experts in the industry and get an understanding of what it's like from a lending perspective from different areas of the industry. And in this session that we're going to start off in a moment, we're going to be talking about credit risk. And then after that, as you can see, you've got the agenda here. We'll be looking at, so the first session, as you can see, is on reshaping credit risk. That will run to roughly about 10:25, 10:30. You can 10:45. We'll move on to assessing affordability in the customer journey. Another little break, and then we'll move on to open banking, new technology, and then we'll finish off early this afternoon on new generations in lending. So lots of different panelists across each session. We hope you enjoy the various discussions and look forward to hopefully getting you involved with the event as well. So if you look at your platform in front of you, you will see a dashboard. You can obviously see our video, and you can make that as large if you want as well to see what's going on. But obviously, we've got an eye information icon on the left-hand side. That gives you information on this session. We've got a important tab on there, which is a speech bubble, which we'd love you to ask questions throughout. The option below that has got information on all of our panelists for each session, a little brief profile from them. And then there's a little download box as well, where you can find out further information about today's event and more background to some of the things that we're talking about. So please get involved with that, ask questions, etc. We'll be running the odd poll as well across the day. We're not going to tally up the results, but next week, Credit Connect will write a write-up of the event and include those poll results. And we'd love to get your feedback. The feedback on the poll is anonymous, so it'd be great to get that from you and obviously get you involved with today's event as much as we can. And then also on the socials, if you can get involved with that would be awesome. We've got the hashtag LendTechTT for you to use. If you can use, Credit Connect tends to use just LinkedIn and Twitter, and we'd love for you to share some of the discussions, your thoughts on the event, etc. on there. As I mentioned as well, we've got a poll, so at the end of each session, we're asked for your feedback as well on that. So please give us some honest feedback on that, because we're always looking at ways we can improve our events across the day. But it's enough from me. That's just a bit of housekeeping. I'm going to hand over, and I'll round up the session at the end, but I'm going to hand over to our event chair today, Chris Warburton, who's going to give a brief profile on himself and his background, and then he will introduce today's speakers and we'll get into the discussion. So Chris, over to you.
Thanks very much, Colin. So welcome everyone. Thanks very much for joining us today. So as Colin said, my name's Chris Warburton. I look after our RO strategy as we do advisory work, but I spent the last 20 years in risk operations, really sort of looking after and sort of running different processes really across the collections lifecycle, the credit lifecycle, including everything from sort of front end origination and sort of approvals around that back to the back end of, say, collections. I'm currently the director of sort of RO strategy. We'll be doing things like a series of videos really to look at some of the latest ideas and innovations out there in sort of this whole sort of credit collections life cycle. So I'm going to be the chair today, and hopefully we're going to have some interesting discussion. And we've got a great group with us. So we've got Ella Mangonis, who's from Nationwide Building Society, and I'll ask everyone to introduce themselves in a minute. We've got Mark Giles, who's the CEO of Go-Car Credit. We've got Ben O'Brien, who's the MD of JWing Consulting. So thanks very much for joining us today and welcome. Ella, do you want to just give us a quick brief introduction around sort of your background? And we just go around real quick.
Yes. Good morning, everyone. I hope you can hear me. I'm Ella Mangonis. I work for Nationwide Building Society, where I'm a senior manager in something called model risk oversight. I think I'm on this panel not necessarily in my modeling capacity, although that is equally quite important, but I think primarily in the sense that one of my roles is to look out for innovations in areas related to credit risk, and in all honesty, in all areas related to what I call financial risks. As a matter of fact, my current title is Senior Risk Manager, Emerging Financial Risks, where I'm looking at issues and threats and opportunities arising from climate change, artificial intelligence, machine learning, and how these things might shape credit risk amongst other risks. In the past, I have been a regulator. I've worked for the Bank of England and the PRA, regulating the capital regime of financial institutions in the UK. And before that, I was an academic in finance. Thank you.
Thanks, Helaman. Seem to have lost Ben. Hopefully you'll come back. Mark, do you want to give a real sort of brief introduction around your background?
Sure. Good morning. My name is Mark Giles. I'm CEO of Go-Car Credit. My background is in decision science and non-prime lending. Go-Car is a specialist motor finance lender. We offer credit repair opportunity to customers who can't find credit with other lenders. And so for today's discussion on credit, in terms of how we manage it, we use a combination of data and analytics for scorecards. We have a series of different scorecards that we deploy. And we also manually underwrite all applications that are approved by scorecards. I'm very much looking forward to the discussion.
Thanks, Mark. And finally, Ben, do you want to give us a quick introduction?
Hi, I'm Ben O'Brien. I'm the Managing Director of JWing. I've been at JWing for 21 years now. So we're a data science consultancy and a marketing agency. But one of our key areas of specialism is in risk analysis, and that was where the firm was born. Risk analysis, consulting and modelling with a particular focus on credit risk, but very much from a data science standpoint. In the last 5 years or so, we've moved heavily into risk modelling solutions that use explainable AI. I started my career with CCN Group that became Experian, building risk scorecards. So I've kind of been doing this for a little bit over 25 years, and I look forward to discussing the big movements in credit risk.
Great stuff. Well, thanks everyone. And I suppose if I look back over the last sort of 6 months, we've just seen seen terrific changes, I suppose. And we've seen restrictions from the pandemic starting to wind down. We've seen some reopening of the economy. However, we also seen, as Colin alluded to right at the very start, some of the energy prices increasing sharply. I was looking at the gas price even last night, which is impacting maybe more generally things like affordability. And there's been a lot of talk around affordability and how does that impact lending? And then we've got more economic shocks potentially coming through with, we've got people coming off the standard tariff, but then we've got the war that's happening in Ukraine as well. And just, I suppose, suffice to say, there's huge amounts of uncertainty, I think, economically in the market. And I suppose from this discussion point of view is like, how do we think about some of those changes, and how do we think about the current environment, and what does that mean for credit risk? Do we need to reshape credit risk? Do we need to change the way we think about modelling? Some of what's happened seems to happen so quickly. Is it going to change? Is that predictive of going forward? I mean, how do we start thinking about that? And I suppose that was really associated with the theme for this particular discussion. And I suppose to start off, I was going to actually ask Mark, as sort of as a lender, from your point of view. I mean, how do you sort of feel around, so I suppose, some of the changes that have come through, and how are you thinking about that in terms of a risk point of view going forward? I mean, how's the environment changed?
Well, I think coming out of the pandemic, the lockdowns, end of furlough, all of the uncertainties that we've been dealing with, we've all had a crash course in dealing with uncertainty and the unknown and change. I think in terms of what's coming next, just looking around to try and find examples of what to expect. It's quite interesting looking back to the end of the Spanish flu in the 1920s and what happened to the economy and people then. The Spanish flu ended at the end of the Second World War, and those two events were followed by very strong economic growth for a really short period of time and exuberance in the Roaring '20s. But that was followed by a long, very, very difficult economic period. And what I'm saying hope in a discussion about credit risk is maybe a little bit naive, but things are quite different today in that we've had we're coming to the end of the pandemic, but we've got a war just starting. We've got a lot of uncertainty, and I don't think that we've had the same exuberance and excess that we saw in the 20s. And so there will necessarily be pressure on affordability, on people's ability to repay on credit. But I think that people have generally become more cautious and are exhibiting more caution than we could have expected coming into this. So we see conversion rates with customers, hesitancy among customers, and a lot of people managing their finances very, very carefully. We speak with every customer, and we ask them, part of the affordability assessment, what do you expect your energy price to become? Now, some of them have received letters, others just say, well, I don't know, I know it's going to be more. But what we do notice in those conversations is people just being careful. And I'm hoping that that is something which persists and which may actually dampen the otherwise be a very strong negative impact on credit performance.
And Ellen, I suppose I'm quite interested in your perspective as as a large mortgage lender as well, in terms of like what your kind of view is in terms of how we think of it going forward as well, particularly in terms of like affordability, as Mark just talked about. I mean, how do we need to take this into account?
May I start by commenting on something that Mark mentioned, and I really hope, this is my genuine hope, that yet again this crisis may be the beginning of what I call a good sustained round of financial literacy among the people of the UK. I think we all need it, and we all need to become a lot more responsible of our finances, as well as know the drivers of our finances, the key drivers of our finances and dependencies. Now, going to your question, Chris, I think that every single lender, and I don't know to what extent I'm stealing the thunder from, and will be stealing the thunder from the next sessions, but every single lender ought to have good credit risk models. They ought to have, and good is debatable, right? Good is very subjective when it comes to that, models that fit their purposes. But equally, they need to have good affordability models, and affordability, whether we like it or not, in one way or another, in one guise or another, plays a huge role in the decisions that are being made. Yes, they play a big role in the yes, no, the accept, reject decisions, but equally, I would say, from my own personal opinion, they play more of an important role in the shaping of the end lending product, i.e. maturity, etc., whether it would be interest only or whether something would be a capital repayment, etc., if these opportunities exist, obviously within a lender. So the one thing I would say, and maybe that potentially that brings us to a slightly different direction, is two things. The first one is what we've seen, whether we can class it as something quite abnormal, quite unique, and therefore there is not necessarily a manual by which we can use to navigate these turbulent times. And the secondly, again, speaking primarily here in my capacity as a modeling person, data. Do we have data to then be able to use to inform our decisions? So I'm pretty sure that a lot of our audience will know the adage that that every single statistician, stroke econometrician, stroke modeler uses, that the past is representative of the future. But when potentially this relationship breaks down, then what do we have to guide us along the way?
So I mean that's quite an interesting point, and maybe Ben comment on that a little bit in terms of like. So I mean, are these like one-off shocks, or do you think this is a new going reality we're going to have to deal with? And then that question around, is the history then representative of the future, and what do we kind of do about it, right? I mean, if it is long term, I mean, what's the kind of approach you've been seeing with clients and something like how they've been thinking about it, Ben?
Yeah, thank you. I'm glad you brought me on that point, because one of the bits that I've noted was this question of the past predicting the future. So I've been in the credit industry for 26, 27 years, but it has got a long run history. So in one sense, we can think this is an industry that has kind of adapted and changed to kind of multiple situations. But the bedrock has been the fact that was just mentioned there, that the past predicts the future. And I think there's been a little small breakage in that, in terms of what's happened with in the global pandemic. And so the question then comes, how do modelers use that information? Do we throw the baby out with the bathwater, or are there methods for us to still use models and improve models sort of going forward? I think that one of the points that has happened is that in the run up to this, we were all in the credit risk industry implementing IFRS 9, and IFRS 9 had a heavy emphasis on forward-looking and macroeconomic factors. So we'll all have had models in place that were trying to establish what the future looked like in different circumstances based on some macroeconomic factors. Now, most of those macroeconomic factors got put into turmoil with not just the actual event, but with the response to the event. So the implications that happened to the economy in terms of GDP, and they didn't translate in that natural way into unemployment because of what the government did. So there's a bit of a black hole of data that says, do we really want to use this data going forward, or do we almost need to kind of remove it from the overall equation? And I think that the industry is at that point where they're searching for answers. And so I don't think the industry has found the kind of the clear path forward. But I think where they're headed towards is, particularly in terms of credit risk modeling and in terms of affordability, is almost a sort of decoupling. That there was already a decoupling of those two things. And it might well be that, as well as building models and rebuilding them quicker, there's lots of methodologies that allow you to kind of adapt quicker. I think there's also something that needs to be considered, which is expert judgment. So the relationship between the affordability models and the credit risk models is probably broken down, because we understand what's likely to happen in the future. So something needs to be done in a manual fashion to upweight the affordability calculation in the overall equation. And I think that's what we possibly need to wrestle with. Now, is that extra data, or is that just a difference in the relationship between these two semi-independent things that are used to make decisions in credit risk?
And you talked a bit there, I suppose, around the IFRS 9 models and predicting future economic impacts. I mean, I see if you just take the pandemic, it almost felt as if we we overshot it a little bit in terms of putting extra reserves in. You've seen a lot of reserves sort of being released back on the balance sheet, and that's sort of. Do you think that's given us a sense of almost overconfidence when you actually look at some of the energy shocks potentially? And we can be a little bit in credit risk, we can be a little bit doom and gloom, saying, well, because we're trying to protect companies from risk. But do you think is there a danger that we've overshot it and we're almost maybe a little bit too cautious now with some of the changes that are coming down the pipe? I mean, do we need to think about that?
Yeah, no, I do think we need to think about that. I think that one of the things that we sort of learned from the multiple kind of macroeconomic crises is that they're all different. And so if we do a read across from this pandemic, which suggests that bad debt risks didn't go up in a significant fashion as they were expected to, and read across to the energy crisis, then I think that we might get caught out because of the fact that they are all materially different. So what can the government do to protect the consumer? Do we have I think we're more fragile economically than we were in the run up to the pandemic. So I'm not sure that the consumer can be shielded as much from the energy crisis as it was from the COVID-19 situation.
And I suppose for the group, I mean, how do you think that changes back to things like risk appetite? In terms of, because certainly I was hearing before the energy price increases, there's a lot of discussion around increasing lending. I think it's probably a little bit off the back of the end of the pandemic, which is, let's get back out there and like start to increase the books again. I mean, do you think that there's a change in risk appetite now, and we need to think about that going forward? In Mark or Eleman, maybe
comment. I completely agree with Ben's observation about the decoupling of macroeconomic changes and customer behaviour, and how government intervention and other factors have influenced that. And I'll come to your question on risk appetite, but we have seen a fundamental change in customer behaviour and a meaningful difference between early arrears and late stage arrears or default in the post-pandemic lockdown in today's environment versus 2 years ago, and that is causing us to use our data and look at our data very differently. I think in the current environment with this uncertainty, it's very difficult, and this is when you think about all the stakeholders and funders, to justify relaxing credit criteria in order to write more business. So I think the default position has got to be to manage credit tightly, to try and identify early warning signals where there might be underperformance. But it's very hard because of what we have certainly seen as a change in customer behavior.
An element, I suppose, from just maybe comment on that, but then also from a model point of view. I mean, what are the other data points we can maybe look at? And I know you talked a bit about before around sort of manual overwriting maybe becoming more important. What's your kind of view? I mean, are there other areas we can look to try and help better predict where that risk might be, and sort of help with I suppose better reflect any changes in risk appetite?
Yeah, thanks, Chris. May I just before I go there, may I just say comment on Ben's and Mark's points, and this is only because I was I was reviewing Nationwide's approach to forecasting macroeconomic variables due to everything that's been going on. I don't want to make this a theoretical debate, but I think one could potentially argue as to whether the neo-Keynesian economic framework that we all subscribe to right now is the right lens to be looking at things, right? When such things happen, right, with a huge government intervention, and everyone, and absolutely the government doing the right thing and supporting British people, supporting workers, etc., and guaranteeing their income for sustained periods of time, right? Which again, is this neo-Keynesian, is it neoliberal economics, etc., etc. But let's put this to the side. But I'm only mentioning this because even this, if someone ascribes to the point that models come from theories, economic models come from theories, then maybe certain theories might have stopped serving us, or we might be seeing things in reality that might not be necessarily aligning 100% with theories, right? And that is a very powerful message. Now, I use that as an introduction to your question, Chris, in the sense that there's always something else to look at. We've all seen, and I'm pretty sure that Ben and Mark can also speak to these. We are seeing the meteoric rise of what we call alternative data sources, right? In a number of areas, especially in the area of credit risk. We are seeing the use of even social media data. As I said, one of my roles is to scour the academic and practitioner literature and see what's out there. And I'm looking, coming from Asia, coming from China, primarily, where there's wealth of data and a very, very cheap ways of gathering and all of this data and mining all this data, that people get credit products simply based on their interactions or the network, what we call the social network. So nothing fundamentally to do with what we would call in the Western world the fundamental risk drivers. We are seeing, however, supplementary data sources being used. A lot of organizations have been discovering the power that their own transactional data have. Nowadays, and I think it's taken the industry a bit of time, but we got there. Are there any, I think, as you said, early warning indicators? Absolutely. And I don't want to answer with specific examples, because I believe that these early warning indicators depend on the circumstance, depend on what exactly it is that you want to look at. So I think, as Mark and Ben said before me, if you believe that the relationship still holds, then you could be looking at certain key macroeconomic indicators. And we all know, and I'll tell you an anecdote if you want. We all know that GDP is not necessarily one of the leading ones, right? There are better leading ones. Every respectable organization looks at, the purchasing, manufacturing, whatever, all of these things. We have the indicators there. If we believe that this relationship holds more, closer to home, there are other indicators that a lot of public organizations and charities, may I add, I think we should not lose sight of charities in the UK that publish very, very useful data, are there to help us.
What about manual underwriting or manual reviews? So we've got Ben, you mentioned it, Mark, you mentioned it because you do that as part of your business model. And we're talking about data, and we're saying, well, if there isn't the data, we go back to having basically expert reviews. I mean, but then how do you judge the quality of that? I mean, there's a lot of discussion and the discussion elsewhere saying, look, you need the data, and the data is going to be much better than necessarily getting people reviewing it. I mean, how do we sort of manage that, or sort of manage that almost like conflict to a certain extent between two different ideas or ways of thinking?
It's a tough balance.
Yeah.
So the way in which we're doing this at the moment is that we are using our data to identify areas where we think there might be accentuated risk. So particularly around the stability, whether it's employment or time in residence. And then we discuss with the underwriters, what are the other things that you might look for that the scorecard has missed, or what are the other indicators in this person's profile that you should consider when making the underwriting decision. So we use the data and the underwriting side by side.
I mean, do you think there's an acceptance that despite all our investment, I suppose, in the modelling, that it only gets so far? It feels like we're almost like still reliant back on a human making a decision on another human. I mean, Ben, maybe bring you into that, or Mark, comment too.
No, Ben, please.
Just on mute. Mark, you're still on mute, Ben. So maybe Mark, maybe quickly comment while we get, or Ben.
Can you just repeat that?
So the we're very much sort of, I suppose, dependent on models, and we're looking around models and like, how do we but it can only take us so far. At some point we're looking at the humans doing the underwriting. Like, how do you manage the quality around that? I mean, can models only take us too far? There's almost like a bit of a split, I suppose, happening between almost like different points of view, almost like belief to a certain extent.
So we found that our target customer base is so diverse that we can't use one scorecard for. We use a series of scorecards. Then to manage the manual underwriting, there are just some very practical measures that I think that you need to monitor in terms of the underwriter's performance, all elements of the decisions that they make, and you try and bring a consistent level of performance right across the team. So where you've got a number of underwriters, you, of course, through training and the discussion, you influence the decisions, but you want that consistent level of decision making. So the approval rate, the amount of time they request more information, you look at the different elements, and where you have outliers who aren't performing in line with the rest of the group, there's you move towards managing that. But it's not a strict. I don't think there's a hard science to it. there's a lot of judgment that needs to be applied in that.
So it's quite interesting that we fall back onto humans making decisions on humans from a loans point of view, which is essentially where we're human beings interacting as a business. I mean, I think it's quite interesting. That's our fallback position. I mean, Ben,
I think it's interesting. I've managed to extract myself from mute now. So I do think it's really interesting because I've essentially spent my career probably moving organizations in the opposite direction. So I am a credit risk person, but a modeler by nature. But we do need to come back to the fact that we do need to train models with appropriate data. And so I think where the human has significant value, obviously, in many different areas, is in just being able to think without being specifically trained on certain outcomes. So the part that I would like to, I think there probably is a period whereby there are more manual decisions that are made. Ultimately, when those are made and then we get more data down the line, then we can start to build models again. So I do think the future is in more modeling and integrating affordability and the traditional credit risk modeling more. But I think there's possibly a small hiatus at this point, at this juncture now, where we do need to move back to kind of a more almost old school position.
So where that's manifesting itself for us, for example, exactly what you're describing there is that we have there's information where we would feel comfortable auto-accepting them, in a population where we feel comfortable auto-declining. But that grey area in between where we need our underwriters, that's gotten bigger.
And
I suppose may I comment, sorry, Chris, on two things. The first one is I don't think we ever left we never left the sphere or the space of people making decisions on other people, right? If you look at it slightly cynically, if you wanted, we never left it. We just put that power in one or more or fewer people, right? Fewer than, I don't know, the workforce of manual underwriters that an organization might have. So, using Ben as an example, who's built scorecards, we've put this trust in Ben and a handful of other people to try and build a good model, right? Because my personal experience, and I haven't been in the industry for 20 odd years, but my personal experience of the industry is that I don't think you ever see a model that is defined by the algorithm 100%, making it to the end. Let's be very clear. I've never seen that. I've always seen models that have statistically the most significant variables, but models that always incorporate something that the experts say needs to be in there. Okay, I don't know, let me give you a naive example of loan to value variable in a mortgage scorecard, right? So I think it would be unheard of if there was a model, be it, a super clever machine learning model or the simplest linear regression model that wouldn't have LTV, right? People might not necessarily be prepared to accept that. And that's why I'm saying that it all goes back to what we fundamentally believe about relationships and how fundamentally we trust the underlying data that help us inform these relationships. The only other thing I want to say is I think what Mark is saying is spot on. Obviously, he knows his business incredibly well inside out, but I would stay on this. This gray area is getting bigger. And I think this is where effectively more organizations are feeling incredibly safe, saying, okay, I can auto reject, I can auto accept, because these are people with what I call very good fundamentals or very bad fundamentals. Let's call it like that, okay? But it's that gray area where there is a lot of uncertainty, where there are all these competing things for people's resources, for people's money, let's put it simply like that, that don't necessarily leave a lot of room for maneuvering, okay? And finally, related to this, I think we live in an era where interconnectedness is huge, right? Can anyone imagine necessarily, I don't know, 70, 80, 90 years ago that a war at some other place in the world would necessarily affect us that much. I think maybe what I'm trying to say through this is that I don't think that necessarily this is a one-off and it will stop, because, I don't know, 6 months, one year down the line, something else might happen, right? Something else might happen that might create the same or a similar situation. So I think I agree with Ben, I agree with Mark that yes, all the modeling in the world is very good. I think the industry will crack the case of these data. Do we call them outliers? Do we call them blimps? Or, how do we neutralize this impact? And, a very popular term in our industry is what we call the long run, right? What are things in the long run? Let's forget about the noise. Let's look at the baseline, the long run. And then we'll just move to making better judgments about how everything is interconnected. I believe that we need to start from that fundamental. What is the interconnection?
So it sounds like sort of like going forward, there's going to be, probably extra due diligence that's needed around that acquisition piece coming through, just because of basically the uncertainty. But that might be going over the longer term. And so is that really a reason around thinking about, well, how do we sort of systematize that? How do we sort of make sure that that's sort of built into our processes in a bit more sort of systematic way? And I suppose with the human interaction, I suppose the other piece I wanted to bring in, I suppose, was some of the discussions happening around things like consumer duty, and look at that forward look around that in terms of like, how do we start thinking about building that into our process and building that into our credit risk adjudication, and even from an ESG point of view as well. Ben, I know you've done some work on the E part of it, but how do we start thinking about the consumer duty and sort of some of the principles that's bringing in as well? And is that going to impact us too? Is that an extra layer we've got to think about?
Yeah, no, I think it is an extra layer. And as soon as you started talking about, Elamos started talking about the long run, and we started talking about the future, then I think you have to bring some of those things in. We've done quite a lot of work around, credit risk and the impacts of the environment. So it's at the beginning, but if we're thinking about sort of long-term change, then the lens of climate change and some of the things around ESG, I know I'm focusing on the E, is probably important for us to consider. So it starts small now, but I think it's going to become a very material part of the credit risk job in the future, is to consider some of those longer term outcomes. And then we're getting back to Element's point about looking in the longer term future. And I think that's a challenge, another interesting challenge that is kind of laid down at the feet of credit risk people first. So the PRA and the FCA have got together on a climate financial risk forum, and I think credit risk has got a large part to play there. But the modelling has now changed. So we're having to model over kind of 25, 30, maybe up to 50-year horizons, and that presents some interesting challenges that kind of almost abstract ourselves from what's happened in the last 2 years.
The E piece, there are a couple of interesting anecdotes. One was effective climate change on house prices, particularly I think it was clay soils. It was in terms of the clay soils driving out, and is that going to impact, I think, on subsidence and those kind of things? Does that impact house valuations? And the other was one you mentioned, Mark, was around, we were chatting about the low emission zones, right? And does that impact resale values, and does that change your credit underwriting decisions as well because of resale values? And I thought there were a couple of sort of like dynamics that were, at least for me, weren't immediately obvious, that we've got to really start thinking about.
Yeah, I think that's right. The ultra high emission zones, or ultra low emission zones, even do pose quite a challenge, and we need to think very different. So in motor finance, we've got two types of credit decision, credit risk. One is the risk of called involuntary default. The other one is a voluntary termination, where the customer decides to hand the car back early into the agreement. And it's particularly around that risk that we need to think about the car that we're underwriting.
Yeah. Okay, well, that's good. And I mean, Adam, do you think, what about things like buy now, pay later, sort of in the background? I mean, what are your kind of views around some of these other indicators that are out there? I suppose, you know, that's not an Abura. Is that an indicator? Is that a you know, potential you know, views on things like affordability? I mean, are those some of the things that you've been thinking about, or I mean, do you have a view on that, or is it much more around sort of things like social media and those kind of things?
May I make a comment there, Chris? Sorry, I'm not very close to this, but I think I read somewhere that I can't remember what it is, but the key statistic now includes buy now, pay later. I can't remember what that statistic is, if I'm very honest. I don't know whether it's the ONS in their affordability data, which might be the ONS in some of the affordability and household survey data that include buy now, pay later. And only this morning, I'm not going to go into names, but you know, only this morning I was greeted online by a title of an article saying ethical buy now, pay later loans for food, which you know, you start, you know, reading these things, and you really start thinking about the pervasiveness of these solution. I think we all need to be very realistically cognizant of this. You know, I've always considered myself quite privileged in being able to work from home right now, and you know, having a safe job. But this is not the case for everyone. So, do I personally see a rise in that? I think I see a rise in that. My personal opinion is that I don't, however, only see a rise in that because of genuine need. I see also a rise in that because there are many incentives being given to customers and consumers, which is almost like and again, I wasn't around, but I've studied the history, almost the equivalent of the get a credit card from us, you will have 36 months worth of, you know, interest-free purchases, or you'll have 36 months worth of interest-free balance transfers, right? So the moment you give someone that incentive, it's very easy to lure them in. So I do believe the regulator will take, as part of the consumer duty, as you mentioned, etc. I think the regulator will take a long, hard look at the industry and will have to make certain decisions. However, going back to our decision, to our discussion, I think the data points generated, financial institutions need, they might already have that in their transactional data, but they need better infrastructure, call it open banking, call it whatever you want, to be able to gather some insights from this. My only final point here is, we are financial institutions, right? We are not someone's parent. We need to be very clear about to what extent we can intervene and to what extent we can make people do things. And that's why I originally said to what, you know, Mark was saying, that I do believe that this is a prime opportunity for financial literacy, first and foremost, to kick in so people can know the rights, can know where they can stretch their limits, can know whether they can live beyond or within the means, etc., etc.
You know, Elimon, you say about we're a financial institution, not a parent, but when we see customer statements and we see a lot of gambling on the statement, then that's not a customer to whom we can extend credit. Similarly, on buy now, pay later, I agree with what you say, but I do think that when you start seeing it used increasingly for food and the regularity with which it's being, the class of good which is being bought, then it's a new source of data, but it is also an important one, and one where we do have the responsibility that we're not impeding a customer's ability to manage their overall cost of living.
There's a question here just come through. Does the panel have a view on whether risk appetite will change with buy now, pay later being used by so many people? And I suppose part of that would be sort of like, you know, do we get to see the data? Does that change your credit risk decision? But then do we need to fundamentally, if we're now aware of it, will it change our risk appetite or our reaction? Maybe not the risk appetite, but our reaction to that. I mean, any thoughts on that?
I think probably there will be changes required to kind of risk appetite statements to cover, because it's such a big and growing thing that I think the risk appetite statements probably will need to to change slightly to take it into consideration. I think the concern is, particularly with the data, I think it's starting to become visible at the Bureau, but it's not exactly clear exactly how to represent this data. I think that the more that that young people in particular start to use this, then the more that it does impact on potential downstream affordability. So even though it's kind of been positioned almost not as a credit product, then the fact that it has some kind of downstream implications means that lenders will need to act on to protect vulnerable customers and to protect affordability in the future. I think, in particular, the fact that this has grown over the course of the last 2 years, and now we have a cost of living crisis, that could snowball into being something more material. So I think the fact that the FCA and the PRA are starting to look at it is absolutely correct, and we do need to. Individual organisations probably do need to look at their risk appetite statements and the data that is being provided by the Bureau, and incorporate that in some fashion.
And Chris, if I may answer, I think I like what Ben said, because that gives me the I think the what is it, the shoulders of a giant to stand on and comment further. I think this is the key. For me, this is the key. I think it's the identification of what we call a vulnerable customer, right? This is the consumer duty. This is a lot of things. I think equally what this pandemic showed us, I always want to be frank, you know, when I have discussions like this, there were people who, you know, there are people who stopped the payments for the right reasons, and there were people who stopped the payments thinking that they can benefit from it. Right now, and all of these two types of people confounded on the issue, right? Where I don't know what was the latest statistic, a third of every mortgage borrower had stopped the payment, something like that, right? But within Nationwide, and I'm pretty sure within other financial institutions, we became very good very quickly at identifying who the truly vulnerable customers were, right? Using data, using analytics, talking to people. You know, we utilized our front office, you know, our front desk colleagues in making sure that they understand the customer, they know our members, they know exactly what it is that they're going through, and feeding back to us. We had the data, we had the analytics, we did that. And I believe this is going to be more what the industry ought to invest in. Now, whether you want to call it affordability, but I believe there is almost like a third branch, if you want it now, appearing slowly within financial institution or within credit risk, that of identifying vulnerability, that of maybe looking at these high risk segments and making sure that you don't completely exclude them, maybe becoming a bit more like a parent, although I think that to me would be a bit more authoritarian or whatever, but certainly managing them slightly better than what we have been this far.
And I suppose it comes back to that intersection between sort of like, you know, do you manage people as a parent, and suppose the regulator telling you to do that versus your risk appetite, and sort of the balance between all of those to a certain extent. I wanted to go back, actually ask you a question around it. You raised a really interesting point earlier, Element, around models. And if our models don't work, and even some of the biggest models, the economic models don't work anymore, then kind of what do we do? And, you know, I mean, are we really facing that kind of crisis in terms of like our history and our models just don't work, and we've got to rethink it? We're going into a much more unstable system. Do you think that's there's a potential for that? That's a much bigger question than even just the credit risk.
Yeah, right? I take your point, Chris. Okay, but let me be very clear though, before, you know, I send people, you know, I don't know, alarm bells ringing or whatever. You know, there's not only one way of modeling things, right? Let's be very fair. You know, you can think of one phenomenon, and you can think of at least 3 different ways of modeling that. I believe that, you know, as I said, the interconnectedness, the unique nature of some of the risks that are crystallizing might, in the short run, not necessarily in the long run, might discount certain of these methods, right? Because certain of these methods rely on very, very restrictive assumptions, right? Or very strict, very stringent assumptions. The one thing that, you know, we are seeing, the one thing I'm happy sharing is that it goes back to what you said. the model is a very good starting point. Sometimes the model is a very good benchmark. Then you need to have the people who have weathered the storms. You need to have the people who know the industry inside out. You need to have, let's be very frank, a bit of a gut feeling. Okay, so that's why I always feel that personally, the people who are in the credit industry should never, sorry, I know I'm diverging, but should never let go of their professional and continuous professional development, right? There's always something to learn about some new thing, whether it's a methodology, whether it's how to interpret the macroeconomic signals, whether it's how to interpret the economy, etc., etc. What I'm seeing is expert judgment coming in. I talk to pretty much like Ben does with his clients, and Mark certainly in his industry fora. I try to, scour not only the internet, but any industry fora. I can see a lot of expert judgment coming in. I can see a lot of model overrides coming in, where the model is saying, yeah, okay, this is me. These are my forecasts based on the data that I have. But if someone, says, okay, I don't necessarily like that because I feel that the recession will be deeper, or there might be a more rapid growth there. I see that. We see that. I think the regulator is becoming more, any type of regulator is becoming more comfortable with that, as long as, and here's almost like a piece of advice if you want to fellow professionals, as long as there is good governance. Governance is paramount when it comes to these things.
I mean, one of the things we certainly learned from 2008, but also from the pandemic, was, if we knew about it, beforehand, we would have been very much better prepared. And I suppose it's just making sure that we're sort of, flagging some of those risks out there. Do you think we're in that kind of environment? I'll ask for Ben and for Mark to comment on it as well. Ben, do you want to?
Yeah. So I will comment on that, but just before I do, I just wanted to comment on some of the things that Elamos was saying there. So I think it's really interesting what you've just talked about in terms of that the question was, do we need to really worry because kind of macroeconomic models might be, some of the big models might be broken? I think to a certain extent, we've got a couple of different types of models going on in the credit risk sphere. We've got the models, the point-in-time models that are trying to predict what's going to happen next year. And then we've got these macroeconomic overlay models. This might be controversial, but the macroeconomic models might always have been largely broken, but just even more broken than they are now. So the point that I made about the fact that each different recession represents itself differently, and also the reaction of the governments and the central banks are different, it means that the macroeconomic models only tended to really work in between recessionary periods, and that most of them, at least were slightly misaligned or very badly misaligned at the point that they were most needed. So that is just a kind of a point to make. I think in terms of what it means for the future, then I do agree that it means model governance and governance in general is the sorts of things that we should press on. So it's not necessarily that we need to make manual interventions the whole time, but we do need to make sure that we have a constant lookout on how the world is changing and how that might impact on the suite of models that we have as an organization and about how those are used. So good, clever model governance, I think, can be a safety net for a number of the things that we've been talking about here right now. But that is a difficult challenge. It moves models up into the boardroom, but it is an important step for us to take.
I think that's exactly right. I mean, we took the decision to rebuild our scorecards. Now, is this a completely ridiculous time to look at rebuilding your scorecards, or are you being ridiculously naive by not rebuilding your scorecards now? So the reality for us is that we're doing this. We're making quite an investment in doing it, but we may not use what comes out of it. We may not like what comes out of it and be able to rely on it. And so it's a much more speculative exercise because of this disconnect that you've mentioned than it normally would have been.
But an exercise worth doing, Mark, because then by the end of it, you will find out whether even your new scorecard can be used as a benchmark, right?
Absolutely.
The more benchmarks you have, the better. It's more of these like early warning indicators, because these new scorecards, and this is like the thing with everything. You use two different methods. One method might be picking up something else better than the other method, right? And you need a plethora of different things. Look at the economists. What do the economists do, right? They scour every single publication out there to try and find these benchmarks, right? What does the ONS say? What does the Bank of England say? What does the ECFIN say, etc., on this, on GDP, on this phenomenon, on this other thing, on employment or whatever. It's very fascinating. It is absolutely fascinating. It's going to, my opinion is that it's going to keep being fascinating, and we will see quite a lot of change. That's why, sorry, I'm going to close by saying every single credit professional should be constantly evolving, constantly learning, becoming a better version of themselves.
For a final word, I was actually going to come back to you, Mark, just in terms of like, so we can all be. Sometimes I feel like I'm a little bit sort of like Chicken Little, where like saying that the whole world's going to fall down. But I mean, the reality is that people still need, in your case, people still need cars, they still need vehicles, they still need, there's a utility there, which is a very positive thing, right? I mean, so I suppose just as you look into the future in terms of like, I mean, what do you kind of see with all the changes that are going on? I mean, there's still a need there, but I mean, how do you sort of see you sort of like leveraging that and sort of like the market changing going forward?
I think that different financial products are going to perform differently in this environment, and having a utility, ultimately the car, I think that I expect that we will be somewhat insulated from pressure on affordability. And what we're seeing is that people are being more careful and more considered about their purchasing and their borrowing decisions.
Okay, well, fantastic. So Colin's appeared, which means it's probably towards the end of the session. So Ben, Mark, and Eleman, thank you very much for the discussion. Really appreciate you being here. Enjoyed it. So definitely some experts and some expert views are happening there. So I learnt a lot. So I hope the audience enjoyed it. So thanks very much.
Thanks, Chris. Really great, guys. Thank you so much for that. It's really interesting to hear all those different views, and it's obviously a really if nothing else, interesting time at the moment for everybody, and tough, obviously, out there for a lot of people. But it's great to hear some industry views on where that's going and some of the kind of thoughts behind that. So, that's great. Like to echo Chris on that. Thank you to Ben, Mark, and Eleman for that. That was really interesting, really good. This session's been recorded, so we'll share it online at some point for people who missed parts of that. That'd be really good. And also we'll round up that we did a poll in there, and there's a question came in as well, and I think we might miss. So we'll share that with our audience as well after this event, our panelists, and get their feedback. So I'd like to round up and say a big thank you to our panelists and our event supporters on this event as well. I forgot to mention in the beginning, Alvaria, Webio, and Lytico are supporting our next sessions. But let me end by thanking Chris as well for his time, and for those of you who we've got another session coming up at 10:45 talking about assessing affordability. So hoping we see some of you on the other side, so to speak, in a bit, where you can log into our next session. There's a link on this platform where you can register for that if you haven't already. But thank you to everybody, and we'll catch up with you soon. Thanks a lot. Cheers. Bye.
Have a good day. Bye-bye.